Welcome to the Retirement Guide podcast. I'm your host, George Jameson, the owner of Capital Wealth Group, a fee-only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. Welcome to the Retirement Guide podcast. I'm your host, George Jameson, certified financial planner and founder of Capital Wealth Group, located in Columbia, South Carolina. Today, I'm excited to bring you an in-depth discussion on one of my favorite topics, charitable giving. But before we get started, for the first time ever, I have a guest on my podcast, Mike Stamen. He's a fellow certified financial planner, and he's also a chartered advisor in philanthropy and founder of Delaware Financial Planning Group in Newark, Delaware. Mike, welcome to the show.
Thanks, George. It's a pleasure to be here and share insights on such a meaningful topic. This really is one of my it's one of my absolute favorite topics that I talk about with my clients.
Yeah, Mike, charitable giving is very important to me as well. And glad to have you here today to discuss this very important topic. So let's start off our discussion about donor advised funds. Mike, donor advised funds, also called DAF or DAF for short, have really gained traction in recent years. Could you explain what a DAF or DAF fund is and how it can be a game changer for tax-efficient charitable giving?
Yeah, when I first learned about DAFs or DAFs, probably 20 years ago, I thought, what is this crazy concept? But as I came to understand how they work, they really can be an essential charitable investment strategy. It's an investment account administered by a public charity. You contribute assets, might be cash, stocks, or could even be other appreciated property. I had a client last year donate a rental property to their DAF. But in return for that, you receive an immediate tax deduction. But the unique aspect is that you can recommend grants from this account to your charities over time. So you can basically time your charitable contributions to maximize the tax benefits, even if the actual disbursements happen later.
So essentially, a DAF allows you to bunch your giving, taking advantage of, let's say, a high income year for a larger immediate deduction, while giving you the flexibility to support multiple charities on your own schedule.
It's precisely correct. It's really just a win-win situation because you can time the deduction when you need it the most. Like you gave an example of having a high income year. Maybe you got a big bonus, sold a property, something like that. But you can then basically let the money grow and donate it out over time, which can potentially amplify the amount that you want to give to your favorite charities.
Great explanation, Mike. And one other point I'd like to make. Let's say you don't want to give all the funds inside your DAF account to your favorite charities right away. You can also invest the funds inside the DAF, which grows tax-free.
That's exactly right.
On to the next topic, bundling donations to meet the itemized deduction threshold. So another strategy that often comes up called bundling donations. This often goes sort of hand in hand, or it can go hand in hand with donor advised funds. But can you walk us through what bundling means and why it might be beneficial for someone who typically takes the standard deduction?
Yeah, it's so common these days under the current tax rules that, so many people just don't itemize anymore. And they're making smaller contributions year by year, but individually, it just might not add enough to exceed the standard deduction threshold. So they're really just not getting any tax benefit. But by aggregating or bundling or bunching your donations together, basically take multiple years worth of expected giving, get that donation, that tax deductible benefit in 1 year, you can itemize your deductions and realize a larger tax benefit. And then you can use that money and grant it out to your charities over multiple years.
Yes, I see this a lot where people are just giving a little amount each year. So they can't itemize and get the tax deduction. If they are close to that threshold, I explain the option of bundling 2 or 3 years of donations together, then gift to the charity or donate to a donor advised fund.
Yeah, that's exactly how it works. So, just work with your financial advisor and figure out what your expected gifts are over a multi-year period. And if you see that your cumulative giving is going to surpass the standard deduction limits in a given year, then you can bunch those together in a single year and maximize your tax efficiency.
So now let's discuss a strategy for those that may have significant growth in investments. I'm referring to donating highly appreciated assets. For instance, if you were lucky enough to buy and hold NVIDIA stock over the past couple of years, and you decided to sell it now, you'll owe capital gains tax. But if you donate a portion of the stock directly to charity or a DAF, you won't have to pay any capital gains on the donated amount. If you're planning to give cash anyway, it may be more tax efficient to donate part of your appreciated stock instead. This can also go hand in hand with donor advised funds again, but it doesn't have to. You can give directly to your favorite charity or church. So, Mike, how does this strategy benefit someone and the charities they support?
Yeah, it's really a matter of getting a double tax benefit. So when you give cash to a charity, you may or may not be able to get a tax deduction, as we've talked about. But when you give appreciated investments, what you can do there is you're basically skipping the capital gains on selling those investments, and so that really just amplifies the potential tax benefit when you donate it directly. So now, as you commented, you can donate it directly to charity. Most nonprofits will accept stock donations, but they can often be a heck of a lot easier, especially if you're giving to multiple charities when you do that in concert with a donor advised fund.
Yeah, that makes perfect sense. So basically, you're leveraging the tax code to maximize both the impact of your gift and your own tax savings.
Yeah, exactly. It's just really one of the most tax efficient ways to give. You using that example, like NVIDIA stock, someone who's held that for a long time has seen really just significant appreciation. And if they sold it, they're going to have a big capital gain that they got to pay taxes on. But if they donate to charity, they can skip that.
Okay, now let's move on to qualified charitable distributions, also called QCDs. Mike, how do QCDs work and who can benefit from them?
A QCD is a really beneficial strategy for anyone who's above the required age threshold, which is currently age 70 and a half. And I'll note here that you do have to be at least age 70 and a half. It's not just the year in which you turn 70 and a half. But with a QCD, you can donate money directly to a charity from your IRA account. And the real advantage here is that the distribution isn't counted as taxable income. And that can be really, really valuable, especially when you're trying to manage your tax bracket or reduce the impact of required distributions. So basically, it's just a great way to get money out of your taxable IRA account on a tax-free basis.
Yeah, it makes perfect sense. I work with a lot of retired clients and we do a fair amount of QCDs. So basically, if you have a sizable IRA and you're age 70 and a half or older, the QCD allows you to fulfill your charitable giving while at the same time reducing your taxable income. So you don't have to pay any taxes on the distribution at all, and neither does your charity.
Yeah, that's it. Like we said, we can do it at 70 and a half, but it really is helpful when you are at the age which you need to start taking the RMDs because it can actually count towards your RMDs. But it's especially helpful for those who are not otherwise itemizing their deductions. And really the difference here is that it's because it's what's considered an above the line deduction, which is almost always going to be better than a below the line deduction. So I'll give you an example. I was reviewing the tax return of a new client last year, and I discovered that not only had she not received any tax deduction for the $5,000 contribution made to her church, on top of that, her income from her RMD had pushed her over the limits into a higher Medicare premium, what you might know as the IRMA surcharge. But had she actually given that charitable gift from her IRA instead of writing a check out of her bank account, it would have actually reduced her adjusted gross income enough. And so not only would she not pay taxes on the distribution, she would have also not seen that premium increase on her Medicare premiums.
Great example, Mike. QCDs are really a no-brainer if you're already taking your RMDs and you're also donating to your favorite charities or church. So let's move on to the next topic, planning charitable giving beyond your lifetime. So, not every charitable strategy is about giving during your lifetime. Many people want to leave a legacy by including charitable gifts in their estate plans. So, what should our listeners know about planning for charitable giving after you pass?
Yeah, legacy giving should really take a lot of careful consideration and coordinating with your financial planner as well as your estate planning attorney. For example, the selection of what assets to leave to charity and how can really make a big difference. I recently worked with one of my clients who had a very sizable estate, and they planned to leave about half of it to 7 different charitable organizations and the other half to various family members. The structure of their plan had them splitting both their pre-tax retirement and their non-retirement accounts equally. But I worked with them and their attorney to restructure their plan so that we first used all of their pre-tax retirement accounts to fulfill their charitable bequests. And that significantly increased the after-tax benefit received by everyone. So if the family members inherit an IRA, they have to pay taxes on this, but charities don't. And conversely, if they inherit non-retirement investment assets, they benefit from the step up in cost basis, but that does not help charities. So at the same time, we also decided to name their DAF as the immediate beneficiary upon their passing instead of specifically name charities. And then we named the charities that they wish to leave their money to as the final beneficiaries of the DAF after they pass. So it sounds complicated, but it's really not. This really provided a couple of different benefits. First, it makes for a much smoother transition process, especially when it comes to retirement accounts. And then second, if they want to make changes to their charitable beneficiaries over time, they can easily update that directly through their DAF instead of having to meet with their attorney to get their trust revised.
Mike, that's a great example of how strategic planning can make a huge difference in legacy giving. By directing the pre-tax retirement accounts to charity and leaving non-retirement assets to family, you're really maximizing tax efficiency and ensuring more wealth goes to where it's intended. Plus, using a donor-advised fund, like you said, for flexibility is definitely a smart move and allows you to make changes without costly updates. Again, this is a win-win for everyone. Everyone puts more money in their pockets, both the charity and the family members.
Everybody does.
Yeah.
Except the IRS.
Exactly. All right, so the next topic we want to briefly discuss. There are also some other more complex vehicles out there for charitable giving, like Charitable Remainder Trust, and there's another one called Charitable Lead Trust. Would you like to briefly touch on these strategies? They're usually for high net worth or ultra high net worth, but I think it's worth mentioning.
Yeah, there's a number of different what we call split interest gifts, where some money goes to charity and some money goes to individuals. But basically, with a charitable remainder trust, as an example, you or someone you love can receive income for life for a set period of time, but the charity eventually benefits on the residual. And on the flip side of that, a charitable lead trust can provide income to a charity for a number of years, after which the remaining assets pass to your heirs. So again, these things sound complicated and they're not for everybody, but there are some circumstances where they can make a heck of a lot of sense. They're both really can be excellent ways to integrate philanthropy with estate planning while also optimizing tax outcomes.
All right, so let's talk about key considerations and potential pitfalls. So while these strategies are powerful, they do come with some nuances. For example, with donor advised funds, you have to remember that the sponsoring organization retains ultimate control of the funds. And once you make the contribution, this is the big one, the transaction is irrevocable. So once you put the money in a DAF, you cannot get the money out. You can only grant the funds to qualified charities. I do recommend working with a financial planner to ensure that your charitable giving strategy is aligned with your overall financial goals. A good planner can help you optimize your contributions, like we said earlier, help you choose the right funds, and time your gifts for maximum tax benefits. So it's important to review the fees, the investment options, and the payout schedule, as well as any restrictions on the charities or receive the grants. Well, what else should people be aware of when it comes to charitable giving?
Yeah, George, those are all good points. So like you said, when you contribute to a DAF, The funds are legally owned by the sponsoring organization, so it's really important to choose a reputable provider. You got to understand their fee structures and be very, very clear about any investment options available and really all of their restrictions and rules. I suggest asking for a copy of their program policies just to make sure you really understand all aspects. But there's no special contribution limits set by the IRS for DAF contributions. So really individuals can contribute as much as they want. But you do have to keep in mind that the amount that they can deduct on their taxes is capped based on their adjusted gross income. And that can range anywhere from 20 to 60% of your income as far as how much you can deduct. And that really depends on what type of asset you are contributing and the type of organization you're contributing to. So it really can get fairly complicated. Another thing to keep in mind with the QCDs, like we talked about before, those you do have to be age 70 and a half, and you do have to follow the very specific rules and processes to make sure that's reported correctly. There is actually a limit on QCDs. It's $108,000 for 2025. And as we mentioned, you do have to be age 70 and a half. But another thing to keep in mind is that QCDs cannot be contributed to a donor advised fund.
All excellent points. Mike, now let's talk about why people give, how to impact when gifting, and gifting with your time as well as your money.
Sure. Yeah, that's an important thing for a lot of people. So most of the clients I talk to, they want to help, they want to give to charity, but I often see that it's unstructured. What I sometimes refer to as peanut butter philanthropy. They're just spreading it around in sort of a reactive manner. So I suggest being a little more thoughtful about how you want to make an impact and what causes are important to you. There's a lot of need in your community and in the world, but you can't help everybody. So give thought to how you want to narrow things down a bit. Consider what area or areas you want to focus on the most, and consider how you want to be remembered. What's your legacy? Think about getting your family involved, even kids and grandkids. I worked with one family helping them establish a DAF. Now they get together each year, and over the holidays, they make decisions together about their giving decisions. It's almost like a mini private family foundation, and it can continue on after the original donors have passed. Now, talk about a lasting family and charitable legacy. Finally, consider giving your time and talents alongside your financial contributions. While most nonprofits have paid staff, they also depend on volunteers for board leadership and service delivery.
Those are some great points, Mike. Like you said, instead of giving a little bit everywhere, focusing on a few key causes that matter to you can really make your donations more impactful. Plus, involving your family not only brings everyone together, it helps teach your kids and grandkids the value of giving back. So before we wrap up, let's summarize the top strategies our listeners should consider for tax-efficient charitable giving. I personally believe donor advised funds is one of the best ways to give financially. It also gives you upfront deduction while allowing for the assets to grow and make annual charitable giving over time. And if you're over the age 70 and a half, QCDs is another great option. And you may want to plan your charitable giving as part of your overall estate strategy, whether by making a charity or a church one of your beneficiaries on an IRA account or setting up a trust to ensure your philanthropy continues beyond your lifetime. Mike, what would you say are your top tips?
I think you really hit it, right? It's consider using a donor advised fund for its flexibility and timing of deductions and supporting multiple charities over time. And then second, when you're eligible, really utilize QCDs to help reduce your taxable income directly from your IRA. And then finally, if you have highly appreciated assets, using them to donate directly to charity or a DAF can help avoid capital gains while maximizing your tax deduction.
Excellent advice. So the common thread here is that thoughtful, strategic planning is essential. Whether you're giving now or planning for the future, aligning your charitable actions with your financial goals can make a significant difference, both for you and for the causes you support.
Absolutely. It's about integrating your values with your financial strategy. And when done correctly, charitable giving can be an incredibly fulfilling as well as fiscally smart.
Thank you, Mike, for sharing your insights today. Your expertise has shed a lot of light on how to make charitable giving both impactful and tax efficient.
Thanks, George. It's been a pleasure, and I hope our conversation helps your listeners make informed decisions about their philanthropic plans.
And that wraps it up for today. Mike, thank you so much for being a guest on my podcast. And to all the listeners, thank you for tuning in to today's episode of the Retirement Guide. Happy planning and hope everyone has a great day. Thank you for tuning in to this episode of the Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. If you'd like a free retirement review, visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.